Real estate syndications offer fantastic tax advantages versus those other people investing in the stock market with their 401k, but some of these advantages are starting to phase out in the upcoming years. One of these advantages is something called bonus depreciation that could actually allow investors to deduct the entire cost of capital improvements in the same year that the expense was incurred. Now, in this video, we're going to look at both depreciation and bonus depreciation, along with actually how it's being phased out, so you can develop a plan of how this could actually impact your overall investments. Disclaimer, I'm a periodontist. I'm not a tax advisor. Take everything in this video with a grain of salt and make sure you consult with your tax professional regarding your own tax situation. Also, if you're new here, welcome. I'm Dr. Jeff Anzalone, a periodontist that's on a mission to save you taxes and to get you out of the rat race with passive income. Go ahead and download the passive income guide that I put together just for you below the video. So let's start off with talking a little bit about how depreciation works, okay? So depreciation is something that the IRS actually gives us, real estate investors. They give real estate investors. It's something that allows these people to write off property over time, okay? They write off their property over time. So this allowance is actually due to the wear and tear and the breakdown and the deterioration of property. Now, under current law, investors can use depreciation deductions each year from pre-tax income to recover the cost basis of a property over the years in which they own the property. All right, so let's talk about the four main ways that you can get paid with real estate. Number one, you can get paid by your tenants. They pay you with rental income. Two, when you invest in a property, it appreciates. Typically, it appreciates or goes up over time. Three, your tenants are going to help you pay down your mortgage. You can have a rent house, you can have an apartment, you can have a short-term rental, whatever. Whoever's renting from you, they're the ones that pay your note. And number four, what we're going to be talking about for the rest of this video is the unbelievable tax advantages and benefits that you get from real estate. Now, as we previously discussed, depreciation recognizes the fact that buildings, appliances, floorings, those kind of things, they wear out over time and they need to be replaced. So the IRS allows us, the investors, to write these off over time. Something else to consider is that once the property sells, depreciation differs in that it's actually recaptured. So the government giveth and the government taketh. So it actually is recaptured, but it's recaptured at a much lower rate. So when investing in a property, you're initially able to take a maximum deduction that could be up to 37%, depending on your tax bracket. But if you're in a high tax bracket, 37% on your federal return in taxes. And then you only must pay 25% when it's recaptured. The difference, the arbitrage between the rates also should make us realize that there's a time value of money. Also, if you consistently invest in real estate, there's a strategy where you can keep using this depreciation, where you can keep kicking the tax can down the road. And it's never recaptured. And you just keep using the losses to offset the income and to offset the capital gain. Again, check with your accountant on that, but there's all kinds of different ways to do this. Now, depending on the type of depreciation used, whether you use straight line depreciation, accelerated, or bonus, which we're going to go over here shortly, you may get to save on taxes for up to 39 years before even having to pay them. Plus, there's other ways you could potentially avoid paying taxes altogether. I just discussed continuously reinvesting, using depreciation, and you can use a 1031 exchange. Now, once you pass on from this world, your heirs are going to get the step up in basis at the time of your death. Thus, the depreciation, it may never be recaptured. Thus, you never pay taxes. And there you go. Now, in real estate, there's three main types of depreciation that I just mentioned. The first one is something called straight line depreciation. The IRS allows owners of residential rental property to depreciate their property over 27.5 years. So for example, the annual depreciation expense, if you've got somebody with a single family home that's the value of $220,000, it's going to be $8,000, because if you take $220,000, divide it by that 27.5 years, you get to deduct $8,000 a year. That's straight line depreciation. Okay. The second one is accelerated depreciation. To utilize this, you would have to go out and hire an engineering group, and they perform something called a cost segregation study. Now, this allows different components of a building or a property to be segregated out. Get it? Cost segregation, to be segregated out. So when they do that, it's actually depreciated over a shorter time schedules of either 5, 17, or 15 years. They go and they identify all the non-structural elements along with any land improvements. So for instance, you could get one of these studies that identify components such as appliances. And it identifies appliances as having a 5-year useful life versus having a 27 5-point year useful life. It's because, think about it, most appliances don't last that long these days. So accelerated depreciation, it actually creates larger paper losses in the early years the property is owned, which has the effect of giving the investor, you and me, more depreciation benefit up front, thus the name accelerated depreciation. This is especially good for us, the passive investor, because many of the syndication deals that we invest in, they have anywhere from a 5 to 7 year hold period. So you can get a lot of this depreciation up front. And the third is bonus depreciation, which is pretty much what we're talking about today. And this allows the taxpayer to front load the depreciation even more than the accelerated depreciation. So by using this, investors and business owners, they're allowed to depreciate items with less than a 20-year life immediately. They can depreciate it immediately the first year when the property goes into service. How about that? Now, let's talk a little bit about kind of the history of where this all came from. It's from the TCJA, or the Tax Cuts and Jobs Act. And whenever it was, I think in 2017, when it was passed, it really expanded the bonus depreciation. Now, before the Tax Cut and Jobs Act, businesses could claim a depreciation deduction of half of 50% of the basis of new assets, like office furniture, vehicles, machinery, software, computers, placed into service in 2017. Used assets, so if you were to buy some used things, they didn't qualify for the deduction. Also, before the Tax Cut and Jobs Act, 50% bonus depreciation could be claimed for QIP, or qualified improvement property, which basically is defined as any qualified improvement of a non-residential building's interior if placed under service after the building was placed in service. So these qualified improvement property costs, they did not include costs for if you enlarged your building, if you put in an escalator or an elevator, or if you did any type of internal structural framework. It did not include those costs. But then when the new law passed, so after it went into effect, investors could actually take 100% first year bonus depreciation deduction on assets, just like commercial real estate and these syndications that we do, place into service between September the 28th, 2017, all the way to the end of 2022. And it also had to, what you could depreciate, it had to fall within the definition of a, quote, qualified property. So in other words, the 100% first year bonus depreciation was set up because it had this time frame. It was originally set up to be temporary in nature. So in a nutshell, think about it. Congress wants to stimulate the economy as it spurs growth, and more importantly to them, they want to make money, right? The way they make money is by taxes. So this is one of the main reasons that they originally developed bonus depreciation, because it encourages business owners to purchase assets that they can then accelerate depreciation to write off more of the cost in the year that they began using it. So here's a breakdown of the 3 steps to take advantage of bonus depreciation. Number 1 is you purchase qualified business property. And this includes, we talked about this a little bit earlier, qualified improvement property. So this is improvements to interior. Remember, this is improvements to interiors of non-residential real property, like a commercial building, as long as the improvement is made after the building is open for business. All right. Number 2 is property with a useful life, remember, of less than 20 years. So again, this could be equipment, vehicles, furniture, fixtures, machinery, anything like that. It does not include the buildings or the land. And then computer software, and then also some of the listed property, that tends to be both business and personal use. Okay, so like a vehicle, you could have a vehicle that you use both personally and for your business. Okay, so to qualify for bonus depreciation, it has to be used for business at least 50% of the time. All right. Number two, then after you do this, you place the property in service. This means that you must start using the asset, whatever you purchase, in your business. So for example, if you're a dentist and you purchase like a new x-ray machine in December of 2022, but you don't start using it until the next month, which is actually the next year, January 2023, you'd have to wait until you file your 2023 tax return to claim bonus depreciation on it. And then after you place the property in service, then again you claim bonus depreciation. Again, you can write off up to 100% of the cost of the asset on IRS form 4562. This form actually gets filed along with your business tax return. So we talked about bonus depreciation. We talked about the three types of depreciation: straight line, accelerated, bonus depreciation. We gave a little bit of history. We talked about how to take advantage of it, why it was done in the first place. So now let's talk about what's happening, because we're hearing all these things about it's actually phasing out. Okay. And probably between now and the end of the year, depending on when you're watching this video, people are really going to be pushing it and talking about it. So here's actually the phase out schedule. So again, from 2017 to the end of 2022, you get 100% bonus depreciation. After that, each year, it phases out by 20%. So it starts off with 100, 80, 60, 40, 20. By 2027, it goes down to zero, unless, of course, we have some sort of change in Congress, new president, new laws, whatever. They could come through at any point and change this. But as of now, the way that we stand, this is how it's going to phase out. Now, as a passive investor, any investments made by the end of the 2022 are eligible again for 100% bonus depreciation. And again, of course, Congress could pass legislation anytime to extend it, revise it, anything like that. So let's talk and let's end our discussion and give an example. Okay. So our example is this: Dr. B decides to make a capital investment of $100,000 into a real estate syndication. Let's say the syndication is in Georgia. All right. So the deal closed in the same current tax year, which at that time was 2022. All right. In March of 2023, the group, the general partner group of the syndication, they actually sent him a tax form, a K-1, which showed a paper loss of his investment. The paper loss was $80,000. Okay. In this scenario, this $80,000, it represented 100% bonus depreciation. Now, if he'd invested in the same asset a year later in 2023, when he got his K1 in 2024, it would have showed an 80%. Remember, it starts to phase out. So his paper loss would go down. So here's a list of the implications depending on, each year, depending on if he would have invested from 2022 to 2026, assuming if he'd invested in the same asset, they got the same cost segregation study, they used the same depreciation potential and everything like that. So again, he invested in 2022, he got his K1 in 2023, 100% bonus depreciation. That showed an $80,000 paper loss. If he were to invest in 2023, it drops down to 80% bonus depreciation, 64,000 paper loss. A year later, 60%, $48,000 paper loss, down to 40%, 32, and then the last year where he could have gotten 20% and only a $16,000 paper loss. So in this example, his depreciation would be $64,000 lower in 2026 versus if he would have invested in 2022. So for the same investment, his paper loss for the 2026 taxes would include, think about it, this is just a fraction of the depreciation from the same asset applied to his taxes. Now, the phase out of bonus depreciation could mean a substantial shift to your overall tax burden if you're able to apply passive losses to other passive income streams. Also, this lower bonus depreciation means you're going to have less depreciation. Remember, this gets to carry forward into future years, which means if that's the case, you're going to potentially have a higher overall tax liability. Now, again, if you're uncertain about your situation, make sure that you check with your tax professional. If you don't have one, make sure that you get one. So what happens next? So again, tax laws are constantly changing, and if you do not change with them, you're going to get left behind. That's like with anything in life, right? Each time something like this happens, the IRS, they always pass new laws which actually help guide us in where they want us to invest our money. So for instance, they're going to give tax breaks to business owners and real estate investors, typically all the time. Why is that? Well, think about it. New businesses and people investing in real estate create jobs, and they create places for people to live. The IRS doesn't want to own a bunch of businesses or be landlords. They don't want to deal with a bunch of tenants. So they offer tax advantages for other people that will do it for them. This is why they give the incentives. And this is something that Robert Kiyosaki's CPA, Tom Wheelwright, him and I, when we sat down together, he discussed a lot of these things and a lot of these changes that's happening. And we sat down on together on an interview, and he went through a lot of this. And I think this interview would be very, very beneficial for you. So if you want, go over here, you can check it out, and I'll see you at the interview.